What if I told you that the cost of your car payment, just $500 a month, could build you a second salary by 2030? Not a side hustle, not a second job, a literal stream of money that hits your account while you sleep every single quarter, whether the economy is booming or crashing. And I went from bankruptcy in 2007 to building multiple seven-figure businesses. And one of the most powerful wealth tools I missed for years, was the dividend snowball. And I ignored it because it seemed too slow, too boring, not exciting enough. And that was a $500,000 mistake. So today, I'm going to show you the exact math, real 2026 numbers, not hypotheticals, for how $500 a month compounds into a second income stream by 2030. And I'm going to show you the one danger zone in this market that could blow the whole thing up if you're not careful. Stay with me. The math is about to get interesting. Here's the actual snapshot. Right now, in March 2026, the Fed has cut rates by 175 basis points since late 2024. The benchmark rate is sitting at 3.5% to 3.75%. That matters because lower rates make dividend-paying stocks more attractive relative to bonds. Capital is rotating out of an AI-heavy tech and into defensive income-producing sectors, energy, utilities, consumer staples. This is the dividend investor's moment. So let's run the numbers. You invest $500 a month. You start in 2026. You put it into a blended portfolio, something like SCHD, which yields 3.5% right now, mixed with VYM for broader diversification. Your average starting yield is about 3.8%. Dividend growth projected at 7% annually. Conservative share price appreciation of 5%. Here's what that chart actually looks like. End of 2026, $6,000 invested, $228 in annual dividends, $19 a month. End of 2027, $12,500 accumulated, $510 in annual dividends, $42 a month. End of 2028, $19,600 accumulated, $854 a year, $71 a month. End of 2029, $27,400 accumulated, $1,278 a year, $106 a month. End of 2030, $36,000 accumulated, $1,793 a year, $149 a month in passive income. Now, I know what you're thinking. JD, $149 a month isn't a second salary. And you're right, especially in the US. But here's the thing nobody talks about. By 2030, that snowball is just getting rolling. By year 10, your dividends start exceeding your contributions. By year 20, you've got a self-funding wealth machine that doesn't need your paycheck to survive. The middle class mindset looks at $149 and quits. The wealth builder looks at $149 and sees a flywheel that hasn't hit speed yet. But here's where it gets really interesting, because the ETF you pick in 2026 changes everything. And one of the most popular high yield plays out there right now, it's a trap. And I'll show you exactly what to avoid in just a second. Let's talk about how to actually build this snowball, because not all dividend investments are created equal. In 2026, there are 3 ETFs that dominate this strategy. SCHD, Schwab US Dividend Equity ETF. This is your high yield core, 3.5% yield right now. Heavily weighted toward energy, consumer staples, healthcare. Exactly the sectors getting capital rotation in this market. 12% estimated 5-year dividend growth rate. Expense ratio, just 0.06%. This is the engine. VIG and DGRO, these are your growth accelerators. VIG focuses on companies that have increased dividends for 10 consecutive years. Lower yield at 1.6%, but historically strong total return. DGRO splits the difference. 2% yield, sustainable payout ratios, positive earnings growth. VYM from Vanguard, 562 stocks, broad diversification, 2.5% yield, up over 5% year to date. If you want to sleep at night, this one does the job. My personal framework for the snowball starting today, heavy SCHD and VYM in the first 2 years to build your income base. Then layer in VIG and DGRO from 2028 forward to capture dividend growth and price appreciation. That blend gets you to that 3.8% average yield with 7% dividend growth, which is exactly what powers the compounding chart I just showed you. But here's the part that nobody is talking about right now, and it could torpedo your entire dividend strategy if you ignore it. If you've been chasing high yield, and I mean anything screaming 10, 12, 13% yield right now, you need to hear this. Business development companies, BDCs, they've been staples of high yield portfolios for years. ARCC, Maine, BIZD, some of them are yielding over 13% right now, and they look incredible on paper. But in early 2026, the private credit market that backs most BDCs is cracking. Major firms are seeing record redemption requests, a wave of software company debt, loans made at 25 to 30 times EBITDA during the SaaS boom is now going bad as AI disrupts revenue and enterprise customers cut software seats. There's a $12.7 billion maturity wall in the BDC sector in 2026 alone. That's a 73% increase over last year. Some BDCs have already cut dividends by 15%. More cuts are coming. And this is the classic middle class trap. You see a 13% yield and you think you're winning, but when that dividend gets slashed and the share price drops 20%, you just handed back years of income in 6 months. The wealth builder move, if you want BDC exposure, stick to diversified players like ARCC with conservative underwriting and avoid anything overloaded with rate-sensitive software debt. And keep it to a small slice, 5% maximum of your total snowball. Dreams don't pay dividends, earnings do. And right now, a lot of those BDC earnings are under serious pressure. So here's how you actually execute this between now and 2030. 3 phases, simple. Phase 1, 2026 to 2027, the accumulation phase. Go heavy on SCHD and VYM. Your only job is to buy shares and turn on DRIP, dividend reinvestment. Every dividend buys more shares. You're building mass and momentum. Don't overthink it. $500 a month, automated every single month. Phase 2, 2028 to 2029, the optimization phase. Now your snowball has size. Start layering in VIG and DGRO. Begin watching payout ratios closely. You want companies with room to keep raising dividends even if the economy softens. State Street at 33% payout? Yes. Something paying out 90% of earnings? Too risky. Quality over yield. Phase 3, 2030 and beyond, the income phase. By 2030, your portfolio is producing nearly $1,800 a year and climbing. You're not done, but now the snowball covers a real bill. Insurance, utilities, a car payment, and it compounds whether you add more money or not. And this is what the wealthy understand that the middle class doesn't. The goal isn't to find a hot stock. The goal is to build a machine that runs whether you're watching it or not. Let me bring this home. You don't need to be rich to start the dividend snowball. You need $500 a month and a DRIP account. That's it. The 2026 market, falling rates, rotating capital into dividend sectors, 6.5% aggregate dividend growth. This is about as favorable an environment as you're going to get to start. But here's the roadblock most people will hit next. They start the snowball, they pick the ETFs, and then the market gets choppy in 2027. Their portfolio dips 10% and they panic sell everything they built. Don't be that person. The protection strategy, knowing what to hold and what to cut during volatility. That's the video I'm dropping next. Subscribe and turn on notifications so you don't miss it, because that's where most people blow up the snowball before it ever gets big enough to matter. And if this helped you see the math differently, smash that like button. It helps more people who are stuck in the middle class mindset find this channel before they make the mistakes I made. Stay boring, stay consistent. Wealth is built in the middle, not the headlines. Peace be with you, and see you in the next one.